Welcome back to Profit Without Panic. This is lesson number 13. I'm Carl Dahm, and today we're diving into the exact construction of the AMP 122 option structure, a core element of my all-market profit strategy. This structure is designed to thrive across market conditions by focusing on positive theta, flat delta, and gamma, while providing long volatility exposure. Creating an effective option structure isn't just a simple task. It demands countless hours of backtesting, analyzing, and refining. Throughout my trading career, I've conducted over 15,000 backtests on various options trading strategies. This rigorous process has led to the development of the AMP 122 structure. Now let's break down the core components of the AMP 122 structure, focusing on strike prices, widths, and deltas. So the upper long, buy one put at the minus 30 delta. The middle short, sell minus two puts at the negative 18 delta. Lower long, buy two long puts at the minus 3 delta. This configuration serves three key objectives. This combination creates a non-directional trade that balances risk and reward while hedging against market downturns. Let's talk about the principles behind constructing this. Out of the money positioning. I use options with 150 to 200 days until expiration. The structure is placed 150 to 250 points out of the money, balancing potential returns while providing a flat gamma runway to reduce risk. Delta and gamma neutrality. Achieving delta and gamma neutrality is crucial. The goal is to keep the total delta and gamma as close to zero as possible, allowing for minimal directional risk. Dynamic widths based on delta. Instead of fixed widths, I prefer to determine widths based on delta, adapting to market volatility. In high volatility environments, the structure can be placed further out of the money, while in low volatility conditions, it may be closer to the money. Crafting the AMP 122 structure requires precision and balance. After personally performing over 15,000 backtests, I've refined the strategy to maximize performance across different market types. The key here is striking a balance between income generation and downside protection. So let's break down the principles. When choosing the underlying asset for this structure, liquidity and cost efficiency are critical. I prefer options on broad market indexes like SPX or ES or the E-mini futures. These underlyings are liquid, meaning you could enter and exit positions with minimal slippage, and they offer cost advantages other individual stocks don't have. Let's begin by discussing the selection of the underlying asset. For the AMP 122 structure, liquidity and cost efficiency should be your top priority. I prefer trading options on a broad market index like SPX or the E-mini ES futures for several compelling reasons. Liquidity and commissions. These assets are highly liquid, minimizing slippage and transaction costs. With SPX, for example, you can trade one contract for the leverage equivalent to trading 10 SPY contracts, significantly reducing commission costs. Tax benefits of the 1256 contracts. SPX options receive preferential tax treatment as Section 1256 contracts. This means that while regular options gains are taxed at a higher short-term rate, 1256 contracts are taxed at a blended rate of around 22%, resulting in substantial tax savings. Diversification through teenies. Using far out of the money put options known as teenies, you can create a cost-effective crash hedge, allowing you to capitalize on significant market downturns. For the AMP 122 structure, I use options with 150 to 200 days until expiration. This range gives you enough time to benefit from theta decay without exposing the trade to significant gamma risk. A longer expiration period keeps the delta and gamma flat, allowing the strategy to perform consistently. There are key advantages to this structure. It provides both income and crash protection. You'll have very little upside risk. The strategy is delta and gamma neutral and benefits from long volatility exposure. The pros: income, trade, and hedge in one. minimal upside risk, positive theta and headroom, delta neutral and gamma neutral, crash protection with long volatility. However, like any strategy, it's not without its downsides. It requires active management, especially during strong bull markets with low volatility, where it may underperform. The cons still need to manage the downside risk, non profitable in initial market drops, underperforms in bull markets with low volatility. Constructing the AMP 122 structure is a meticulous process that requires careful consideration of underlyings, deltas, and expirations. By following these principles, you'll be well prepared to implement a strategy that thrives in various market conditions. In the next lesson, we'll explore a vital topic, essential for the effective application of the AMP 122 structure. I will go over how to wisely employ leverage with advanced margin strategies. Without understanding these concepts, the AMP 122 cannot be implemented effectively. Click on the video on your screen to continue to the next lesson.